A decline in sales often signals trouble. But for Shell Philippines in 2025, that was only the starting point, because what happened next was far more telling. Net sales dropped by over 5%, yes. Yet gross profit rose, and net income surged by nearly 70%. For a company in a fiercely competitive, low-margin industry, this was not a simple rebound. It was proof of new discipline, sharper choices, and, most of all, financial coherence. The transformation revealed itself in cash generation. Operating cash flow jumped from 7.47 billion pesos to 10.69 billion pesos, while Shell Pilipinas swung from a free cash flow deficit to a solid surplus. Through tighter inventory controls, smarter logistics, and more selective investments, Shell Pilipinas got better at converting inventory into hard cash, a rare trait in this business. The balance sheet grew stronger, not just bigger. Equity increased, retained earnings rose by a third, and debt ratios improved. Net debt and short-term loans both fell, even as the company secured a new medium-term facility. The result, not a flawless balance sheet, but a much healthier one, evidence of a company managing volatility, rather than simply enduring it. Shell Pilipinas achieved this while refining its business mix. Fuels still drove performance, but the approach changed. Despite intense competition, overall volumes grew. Fleet solutions, commercial fuels, and aviation posted double-digit gains, with aviation earnings more than doubling. Non-fuel retail also expanded, with notable growth in convenience and digital offerings. A focused approach meant that every litre sold delivered more value than before. Supply chain investments became an earnings tool, not just a support function. The Davao import facility brought regional flexibility, cut logistics costs, and improved service reliability, vital in a year when global fuel prices fell. Guided by a clear mantra, defend, grow, deliver, Shell Pilipinas protected its core, expanded its strengths, and translated those gains into cash and stronger ratios. Return on capital improved, liquidity strengthened. The most visible signal of renewed confidence came in March 2026, when the board restored dividends after a 3-year pause. For investors, that was more than a payout. It was management's endorsement of the company's health and outlook. Risks remain. Competition is fierce, regulatory issues persist, and volatility is part of the territory. Yet, the direction is unmistakable. In 2025, Shell Pilipinas did not become more exciting. It became more dependable. For investors, that is the real story. Behind the numbers, Shell Pilipinas showed how resilience, discipline, and focus can inspire genuine confidence, turning a year of lower sales into a story of renewal and a business fit for the future.